here to run through the markets, talk a little bit about trading. And sorry, my hair is insane. That's why I wear a hat every day lately, because during this quarantine, I didn't get a haircut leading up to the quarantine, and then now we've been on quarantine for 2 months, and my hair basically grows out. Instead of just getting longer, it just gets bigger and bigger and bigger. So if I don't wear a hat, my hair fill this room. No, not really, but So anyway, what was I talking about? Oh, right. Talking about a little bit about trading. This week, we are talking about breakout trading. So I said that we'd find a strategy to talk about, one strategy each week for the next 3 weeks. Super simple strategy that then you can take back and apply and start working on. Remember, I said it's very important to do the homework. You got to do the homework. So what I mean by that is, we're going to talk a little bit every day, a little tidbits about a strategy. And this week, it's a breakout strategy, just talking about simple breakouts. And breakouts themselves are very simple. We look for an area, wait for it to break, and then we trade that. The not so simple part of that is determining, where do I place my stop loss? Where do I take profit? Because those are very important, right? One manages your risk, and one actually allows you to capture some sort of a reward for your efforts here. So, just the breakout itself, yeah, that's super easy. But the stumbling blocks come into when we start looking at the risk and reward aspects of it. And then also, once we start looking at risks and rewards, it makes things very real, because now once we put a stop loss in, every trade can't be a winner. If we never put a stop loss in, we could always say, well, eventually it'll come back to that, right? Unless you get margined out. But it becomes real at that point, because now the market's broken a channel and maybe continues, or it's broken a channel and maybe comes back against you. And when you start realizing losses, that's when the subconscious comes in and starts questioning what you're doing. So it's very important to have done the homework around what you're doing, right? Pick a strategy. You don't have to choose now. We've got 3 weeks of different types of strategies we're going to look at. But pick a strategy. Pick a money management and a trade management strategy to go along with that, and then test it. It's so important to actually test it. Do the homework. Go back over 100, 150 trades in the past. Know what to expect. Look at the market not with blinders on. Look at the market in reality. Sometimes your trades are going to win and sometimes your trades are going to lose, and mark both of those down and figure out. When you do that, you're going to truly see a quantitative result of what your strategy has done. And then, from that, you can go back and you can say, well, okay, if I've been using this for a stop method, if I tweaked it to this, how would that look? And you go back and you test that over 100 trades or 150 trades, and then you see what your outcome is. Okay, well, if I tweaked my take profit point, and we're going to talk about what these are, so it's not just theory. I'll give you some starting points to work from. And then you can see what your result would be there. And then once you get one result that works well historically, now you're going to start forward testing that in a paper trading account. There's nothing urgent about what we're doing. I know we're all in lockdown and we all want to get some new side gig going before we start to get back to work. Or there's the fear that when the country opens, we won't go back to work, right? Because that's a very real probability for a large number of people, and it sucks. But that's the reality. So I'm sure there is some feeling of a sense of urgency as well around that. But if you try to rush this, you're going to create a big hole for yourself. It's so easy to rush it, try to just shoehorn a strategy in, and your subconscious will never buy into it. You'll never execute that strategy properly, and you'll never be successful with it. That's just God's honest truth, the freaking reality of this game. It's a hard game. It's simple. Trading is simple, but it's hard mentally, and that's why we have to do all this practice, do all this work. So practice. Let the time go by. If it takes you 2 months or 3 months to get through a live forward test in a paper trading account, that's okay, because at the end of that time period, you're going to have back tested and then forward tested a system. You know exactly what to expect. You know that you may have series of losses, But because you've tested it and you've got a good understanding of it, your subconscious is going to buy into it. I keep touching the back of my head. When I touch the back of my head, I'm talking about the subconscious. For me, I'm sure the subconscious lives up here somewhere if you're talking to a brain scientist, right? I just always think of it as that little voice in the back of your head. So I always go, my subconscious, and I touch the back of my head. Anyway, you're going to buy into it better because you've actually done the work. You've actually put in the effort. You've put in the homework. You've prepared yourself both physically and mentally. Physically prepared in that you've written down, taken notes, and made, tracked your results. Trade by trade by trade. And at that point, you've got 300 trades of history, back tested and then forward tested, and you know exactly what to expect. And then you can go with confidence into the market, right? So anyway, that was a long introduction. So we're talking about breakout trading. There's a couple of different ways to approach it. One super simple method to trade a breakout in Forex is using the breakout box tool that we have on our website, right? I say me, that I have on the website. There's a breakout box tool. That tool is super easy to use. We utilize that in Forex just by looking at which currencies are moving and then pair those together and then click a button. I'll show you that right now. But then once we get through that, I want to move over and talk about breakout trading as it relates to a speculative market, which is the futures market or the crypto market, right? Those are speculative markets. The Forex market, and I said this yesterday, I'm going to say it again, does have a big speculative side to it. However, the majority of what's actually done there is utilitarian. Those markets exist. You're tracking full economies, and those markets exist for cross-border trade. While there is a speculative side, it moves differently. And it's also tracked differently than any other. Well, crypto is kind of the same because you can pair crypto versus crypto, but speculative versus speculative. Anyway, we'll get to that at another time. There's probably more that we want to get into right now, especially because I always have a limited amount of time for the next few weeks for this call. Beginning at the end of May, I'll have more time for this call if we need to go past 30 minutes. So let's pop over here to this chart, and let's have a look at what's here. Let's pull this up. So in the crypto market, we just look at what's moving, right? We can look at this chart. This is a currency strength chart. It's available on the website as well for those of you that have subscription to the tools. If you don't have subscription to the tools, you get all of the tools, only $297, by the way. That's a crazy good deal. It's basically just paying me back for the coding that went into it. So anyway, we can see what currencies are moving, which currencies are moving to strength, which currencies are moving to weakness. We can see that the CAD the New Zealand up here has certainly been a strong currency. New Zealand is really choppy. I've taken a few New Zealand trades, but I really don't trust it, to be honest with you. It's got high spreads, and it's kind of manic. It's a lower volume currency, so it's not going to be as smooth as something that has a lot of volume behind it. But the CAD's interesting. The CAD certainly is looking good. It's been strong for the last, probably 45 of the past 5-minute period. So it's certainly a stronger currency. Yen is weaker, but it's flat. Most of our currencies are flat coming into the day. USD is pushing down, so potentially a CAD USD pairing could be a trade there. However, when we pull up the actual CAD USD pair, we can see it's moved 129 pips. Average is about 129, 130 pips. Does it mean it couldn't move more? No, it can absolutely move more. We just look at what's the likelihood of it. It's already exceeded its range unless something major happened with news today. I wouldn't expect it to continue. I mean, it certainly can continue any further. We're just saying what's the likelihood of it. It's probably not that likely. Everything else has been flat, so I don't really see any great trading opportunities here. Potentially, CAD versus the yen could be a trading opportunity for us. It's moved 36 pips for the day. It typically moves about 70 pips, 65 to 70 pips. So, is there opportunity for that one to continue on? That one has some potential. I mean, the yen has certainly been flat, but there is potential for that to move. So in order to use that, we're looking at a couple of different pieces of information, but we're looking at what the range has been and what its current and what it typically is. We're looking at the direction it's been moving leading up to this, so considering the trends. we're looking at the volume detail to understand if we've got a bias to the buying side or selling side, and we see that we've got a buying bias here with this. So we could park a trade on the CAD versus the yen. There's not a lot of momentum, so I'd rather see something that's really diverging from one another. And we've got some divergence, but I mean, we can see the yen is just, it's flat. The yen is flat. So it's very easy for this to change direction. And if we get, you know, when you've got kind of a one-sided pairing like this, if just one of them changes direction, it's going to, you know, impact us and potentially stop us out. Oops, where am I wanting to go? Let's pull that CAD yen back up over here. There it is. So, you know, with that said, though, you know, we've only moved 36 pips on an average of about 65 to 70. So does it have 20 pips in it to move beyond this if it breaks through? Yeah, it's got it. It's just not active, and that's, you know, we want to see that activity. We could, though, to keep it super simple, we've got a strong currency and a weak currency. We could just place a trade at the top of that box, and if it takes us in, great. If it doesn't, that's fine too. Now, this is one way of managing a breakout trade. Now, I've used foreign exchange here as a kind of a simple the way of setting it up. But talking about trade management, we're going to get into a breakout again, looking at a speculative market here in just a moment. We talked yesterday about breakouts and used the S&P as an example. We'll probably use the S&P as another example today. But managing this breakout, you know, what we've done here is we've just got a very simple strategy where we're looking for this to, we're giving it 20 pips of risk, and then we're looking for 20 pips of reward here at the top, right? So it's a 1-to-1 risk-reward ratio. However, when this breaks through, or if it breaks through, now yesterday we placed a couple trades. They just reversed direction as the U.S. session got going. They never touched in. We just closed those trades down. So, you know, we didn't end up, we had trades on, but they never touched in, so we closed them down. So we didn't win, we didn't lose yesterday. So if this breaks through the top of this box and touches us in on the trade, then what will happen is the stop loss will begin ratcheting off risk. So pip for pip, we have a trailing stop. Mathematically, that works out in our favor. We've got a 1-to-1 risk-reward ratio. So we're always going to win 20 pips when we win. But when we lose, on average, there's going to be the odd time where it might touch in and then go back immediately and stop you out for a full loss. But typically, you know, when something breaks through that area, we're going to see some momentum carry it through, especially if we're pairing currencies together that have some momentum, or if you're trading an instrument that has momentum to it. You know, so like if you were trading a strategy like this on, let's say, you know, the S&P, right? You've got limited volume coming into the U.S. session, but then you've got a lot of volume between, you know, 9:30 and 10:30 as the new session begins. You can really capitalize on that new volume by trading a strategy similar to this to say, hey, you know, I'm going to set up based on something, and we're going to get into this in a second, looking at average ranges and whatnot. But you could say, you know, as the market gets going, based on the average range this typically trades, if it breaks through this area, then I'm going to enter the trade. Well, anyway, taking that 1-to-1 risk reward, I think I was going down kind of a rabbit hole, you know, way off tangent. By having a 1-to-1 risk reward, that's great, but it becomes better because when we're losing less than we win on average, and on average, when you do something like this, and you have to back test it over time, but on average, you might be losing, if you're risking 1% and making 1% or 2%, you know, if you're risking 1% to make 1%, you know, on average here, because of the way this ratchets off risk and you're playing momentum to your side on that break, you'll probably on average lose, you know, 0.6, 0.5, 0.4%. So if you're making 1%, you're losing, let's say, even 0.6%, you've got a positive expectancy. You're winning a greater amount than you're losing. And that's really, really important when it comes down to the money management side of things, is to set up something that gives us the ability to win more than we lose. And that's where trade management comes in, risk management comes in, and then, of course, you know, mindset to execute that consistently comes in. So anyway, that's taken me way longer than it needed to, but I hope that gives you some quality of content and good education there around what we're doing here. So that's this. Now, here's the thing. If this never touches it and moves back against, back the other direction, just like yesterday, give it a couple hours. If it doesn't move through here and fill us, then we just close it down and move on. We haven't made anything. We haven't lost anything, right? All right, so let's get this out of the way. Talking about breakouts on an intraday basis. So this is the futures market. So yesterday we talked about the S&P. Let's just bring up the S&P again. So yesterday I mentioned biases and I mentioned filtering systems, right? Everything that we do with trading, everything, no matter what indicator you put onto your chart, it's not a magic box. It's not a magic line. It's not a magic thing that just tells you, oh, take this trade. It's beautiful and you're going to win. It's not what it is. An indicator is a filter. And you can apply as many indicators as you want to your chart. And what they're meant to serve as is a way to filter the data. What am I looking at? What are my eyes seeing? How can my eyes filter that information down, through various lenses to leave me with a potential trading opportunity, right? The waters are murky when we come in to trade. The waters are murky. It's like this brown, murky mess, right? Something's happening, but we don't really know what. So in order to make sense of that, we're going to put it through various filters. I look at a 4-hour time frame and I filter it down. I say, okay, what's my bias in the 4-hour time frame? And I just use moving averages. We talked about that yesterday, just moving averages. That's the first filter. Then I go to a 30-minute. Say, okay, my bias is long on the 4-hour. Go down to a 30-minute. Let's drop it through that filter. What's the bias in a 30-minute? Is it also long or is it short? If the biases are reversed, then we can just stop right there. Nothing came out the other end, right? It got clogged up because there was a conflict of data. But now it comes out the other end. Now what do we do with it? Now we can apply another filter, which could be a support or resistance area. And then we want to look for, a break of a certain area in the direction of the trade that we're looking to go. So let's go back over here and talk about that. So we'll just make the ES a little bit larger here. So we talked about that yesterday. On a 4-hour basis, the bias was long. On the 30-minute basis, the bias was long. So that told us that we're looking for buying opportunities. Now, how do we find a buying opportunity? Well, that's where we turn our sights to potential support or resistance areas. Now, I drew these lines based on a 4-hour time frame. So, one way to look at it is to say, hey, if we break a certain level on a 4-hour, this key level, because the bigger time frames those levels are going to be a little bit more carry a little bit more weight to them than they might on an intraday basis. So we could either look at that key level on a 4-hour, or if we wanted to really get into things a little bit more quickly, we could also look for key levels on a 30-minute. So yesterday we talked about the 30-minute time frame. Key level being more around the 2860 area, which is right through here where my cursor is. It's right through here is 2860. Now we can see yesterday as the live session got started, which was about right here, my time. So this is where the live session began. And then we can see it really struggled here. It pushed up, repelled back, pushed up, repelled back. And then later in the day, we can see that it broke through and then used that level as support. So we had resistance up here. So we can see resistance, resistance, resistance. So that it hit that ceiling. Remember, we're on that trampoline. We're bouncing. We're jumping. When we jump too high, we hit our head in the ceiling. Hit our head in the ceiling. Hit our head in the ceiling. Pretty soon the ceiling kind of weakens. And then we get one more good bounce and we break through that ceiling. Well, we're surprised when we break through the ceiling. We spread our legs apart and we land on the floor. And that's exactly what happened here. Bang, 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 bang. Break through. And now, boom, come back and we've got support. And so now we could continue that forward. So we talked about 2860, looking at that on a 30-minute, and that could be, just using, into what we talked about. That was, we're coming into the day. We were over here when we were looking at this, and we're saying, okay, well, these are areas where on off trading hours, we've been seeing a level of resistance. We set that up. If we break it, great. Now the challenge here becomes one of two things. It broke it here, it pierced it, came back against us. It broke it here, it pierced it, it came back against us. Then it finally broke it here and moved through. So there's two ways of trading a breakout. Okay, there's two ways of looking at that breakout. One is to simply say, if we break that channel, we're going to trade it. That's one. That's one way of trading a breakout. Just straight up, if it breaks that, I'm in. The other way of looking at trading a breakout is to be a little bit more patient. And on whatever time frame we're trading on, if we're trading on a 30-minute time frame, for example, we could wait for it to break through the top of that area, close above that, and then say, okay, great, that's my level. Now I'm going to be patient, and I'm going to wait for price to come back and retest that level. So you can either just break on momentum and say I'm in, or you wait and you say, okay, it's broken, it's closed above, now I'm going to set that and wait for price to pull back, and then trade from that level as kind of a pullback from that breakout, right? So we're going to trade from that level later on. Pros and cons to those. Pros and cons to that. One, so the pro, if you're trading a breakout, just a straight up breakout, it's going to break on momentum. The pro to that is you're in as soon as it breaks and you've got potentially momentum on your side. The con is, as we saw earlier, sometimes it hits that level. It might just break through it by a tick, 2 ticks, just beep, just peeks through and then reverses against you. So that's the con. There's 50-50. Half the time it's going to do that. Half the time it might break it and run on. Our brain will filter. This is where doing the homework comes into play, because our brains filter stuff. We see more of what we want to see, of what we're looking at. So if we come into the market and say, man, every time it breaks a level, it just moves. So then if you start going back and you look, through historical time, your brain is going to see every time it broke through a level and just moved on, because you want to see that because it supports your belief. You maybe formed a belief based on 1 or 2 pieces of data, and then your brain wants to support the belief. So every time something happens, your brain goes, oh, there it is. See, it works. Oh my God, I've made the Holy Grail. The reality is, half the time it works, half the time it doesn't, because that's your odds in the market. The market can either go up or it can go down, and it does both, right? So the sooner I don't know, people argue that all the time, but that's reality. My reality anyway is that it's random, fairly random. We can find ways to exploit the randomness and cut down the noise to create less randomness and find edges, which is what we're trying to do. But at the end of the day, you've got 2 outcomes of a trade. It's either going to go up or it's going to go down, right? Someone tell me if I'm wrong, but that's what happens. It goes up or it goes down. I mean, granted, people go, oh, it can go sideways, but it goes sideways in a freaking range. It doesn't just go beep. So it can go up or it can go down. Anyway, I'm getting excited because there's so many ways to spin what happens to the marketplace, but everybody ends up talking about the exact same thing at the root. So, talking about, so that's where doing the homework comes into play. Go back and look, and look, take the blinders off and look for all the times that it goes to that, touches it, and moves back against you. All the times it touches, breaks through, and just continues on. You've got to figure out which one works best for your subconscious. So there's the pro and the con to that. Same thing with waiting for it to break a level, close above, and then you set that level and you wait for it to pull back to that. So it's broken, it's closed above, it's giving you confirmation that it's moving, and then it comes back to that level. That's where it touches you in, and then you trade it on from there. Because the common theory is that, again, something that's been resistance becomes support, something that's been support becomes resistance. The challenge is, and I mentioned this yesterday, it's not really just a line. If it was just a line, everyone would be trading from the same line because we'd all see the exact same thing. What it really is a range. That support or resistance is an area. And I know I don't point that out enough, but if you've listened to me and you've listened to the previous calls and previous sessions, I always say it's in that 2800 area. It's in that 2860 area. Because it's not real. 2860 is that line of demarcation, but it's really going to be a few ticks, maybe a point or two above and below that. It's a range. So the pro of letting it break, close above, and then move, and then come back to that level is you've got some level of confirmation. That works well for people subconsciously. Wow, it broke it. Now it's confirming what you thought was happening. It's confirming that move above that level. And now it's just simply doing regular price action where it's coming back to a level and then moving on. So people subconsciously, they like that confirmation, right? People want to wait. They want a confirmation that they're going to be right. Let go of that, because you're not going to always be right in the marketplace. You can confirm what you think, but then still move against you, by the way. So be aware of wanting to get too much confirmation. Too much confirmation ends up being paralyzed. Paralysis. If you could be too much confirmation basically is paralysis. And at that point, you end up don't taking trades, or you end up taking trades really, really, really late, and that hurts as well. That's just as bad as being way too early. So anyway, so the pro to that is it gives you a level of confirmation. The con to letting it break and then coming back to that level and then trading from there, the con is it doesn't come back. Sometimes it does. Yesterday was a great example of where it came back perfectly. That's an amazing, it's amazing that it just happened to be a great example here right now, because it doesn't always do that. It doesn't always come back to that spot exactly like that and then move. So the con is sometimes you won't get filled. Sometimes when it comes back to that level, it blows through it the other direction. So again, that's where the homework comes in. You've got to sit down and look at a history, not the last 3 days, not the last 5 days. You've got to go back and look at 100, 150 potential trading opportunities. You've really got to get a large breadth of data to go through, because the data size is huge. That means everything when we're looking at this. We're talking about mathematical stuff at the end of the day. I mean, we're trying to quantify something. So a scientist, and I'm certainly not a scientist, but I did go through science in school, just like everyone else did, in both in high school and college. And the scientific method doesn't say, go get 2 data points and based on those 2 data points, move forward. It says go get data. And the larger the sample size, the more accurate your data is going to be, right? The larger the sample size, the better you get. So, those are 2 ways of looking at our entry. So we've used some indicators as your filter, right? And then now we've got support or resistance as that final filter to determine how we're going to make a trade. So very, very, very simple process. I don't have any fancy indicators on here, nothing that costs you anything. These are indicators that are included with your trading platform. Every trading platform has these indicators. So we've got the indicators in here. Moving average, so 2 moving averages, a short moving average and a long moving average. Look at those indicators to give you an idea of bias. Right? We're not just simply trading moving average crosses, which again is also a very simple strategy that can be effective if you manage it properly. But we're using the moving averages to give ourselves an idea of what the bias is, and we're looking at that on multiple time frames. So what's my 4-hour bias? What's my 30-minute bias? And you might be, if you're trading in a lower time frame, you might look at your 30-minute bias and your 5-minute bias, whatever it might be. Or maybe your weekly bias and your daily bias, depending on what you're wanting to trade. But anyway, we look at the bias for direction and make sure they're confirmed. And if they're confirmed, then we move down and we look at support or resistance to give us an idea of where we could trade from based on what that bias is. So then we have to make the choice. Are we going to wait for it to break that level and enter immediately? Or are we going to break a level, confirm the break, wait for the pullback? And it works the same way on the way down too. Break a level, you want to enter right now, or break a level, confirm the close below that level, wait for it to come back over time, and then trade it short. So that's what we have to do. Now, waiting for it to come back is really more of a pullback in my mind. It's not really a true breakout, but people call that a breakout strategy as well, where it's broken, come back, and then go. So those are a couple of ways to approach it. I am running short on time, so let's go ahead and wrap it up. Tomorrow, we'll talk about ways to manage the trade, because that's just as important as well. It's probably more important, really, at some level. I mean, it's good to find an entry. It's good to have something that gives you a little bit of an edge on entering the market. So there's always the old adage, trade. The trend is your friend. The hang up there becomes which trend, right? That's why we use multiple time frames to chunk down some of that noise. But then once you use your entry point, you found your entry point and it does what you think it's going to do, and you enter, managing the trade becomes paramount, because we have to take the right amount of risk for us to buy into the trade in the trading process. So the right amount of risk is key, and the only way we can manage our risk is to have stop loss points. So where do we place our stop loss? Let's talk about that tomorrow. Same with taking profit. At some point we have to realize profit. If it's all unrealized, it doesn't matter. So if we just simply leave trades open, they float up, they float back, they go against us, they go for us, and we never take any profit, it's all for nothing anyway. So we've got to find a way to take profit as well. We'll talk about ways to manage both of those processes tomorrow. And the pros and cons, again, because it's important to know the pros and cons so that you can develop your trading plan. The goal of all of this is to have you develop a trading plan. All right. Real quickly before I wrap, let's run through this. Oil still in a downward trend. The 4 hours down, 30 minutes down. So oil still looking at opportunities to go short. I wouldn't, personally, we got below $10 yesterday again. We talked yesterday, about where we were looking at either breaks of certain levels or pullbacks to key levels. This is one, we can see here on the chart, 1366 was a key level on the 4 hour basis. We came back to it and then pulled down from there. Breakout, if we're looking at breaks of the lows and off hour trading, wouldn't have gotten us, I guess it would have gotten us there. Would have broken it right here, but then it would have struggled for a bit anyway. Gold is on a 4 hour, we're in a long trend. On a 30 minute, we're short. So for gold, perfect example, biases are mixed up. We don't do anything with gold. All right, so we've got some opportunity to potentially trade long here in the ES. We've got potential here to trade short here in the crude, just depending on what your entry process would be. Did I have my screen on when I was talking about that stuff? I don't know if I had it on or not. Anyway, you guys know what I'm looking at over here. For Bitcoin, for Ethereum, in the crypto markets, same thing. Looking at where our 4 hour bias is and then trading in that direction. So, ETH, Bitcoin, both are in long biases, meaning that we'd be looking at buying ETH or buying Ethereum, or buying ETH or buying Bitcoin. Both are looking long. Bitcoin is coming to a very key area up here on a 4 hour basis. 7750 is a pretty key area for us. We've hit it and repelled. And right now we're bumping up against it again. So if we can break 28, if we can break, my brain's over here on the ES. If we can break 7750, great spot to look to continue with that upward momentum here in Bitcoin. Ethereum, the next key level is 200. However, if we look on even a little shorter term basis here on the 4 hour, we could even look at 196, 197 as areas where here recently we've been hitting and repelling off. Although 200 is certainly a big number for Ethereum. So if we break this 197, that could be an opportunity to continue long. And if you're looking at something to scalp kind of short term, you might even look between here and here as your 200 is your take profit point. Of course, I feel like it'd be better to wait for it to pull back and get it at a little more of a discount. So if it pulls back to 193, 192.50, be a great spot to buy that Ethereum from, as we've talked about previously as well. So anyway, those are the levels. That's it for me for now. I got to run, got to get into another call. If you like what you're hearing, share it with your friends. If you like what we're talking about, if you feel like you're getting some education out of this, I'm going to tell you the stuff that's real, the stuff that works, and I'm going to keep it super simple because you don't have to get crazy complicated, especially in the beginning. Keep it simple, make it easy, and do the stuff that works. So there it is. We'll talk about trade management tomorrow. Have a great day.